Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 23rd of October. I'm Daniel Lam, your host for the podcast. When I heard about the issues from private credit, I immediately linked it up with subprime back in 2007 to 08. There's some similarities between the current environment and also back then. The monetary policy in the US on the restrictive end, the economy weakening, and both started from cheap money. Subprime from the times following the September 11th events, and private credit coming from the massive underwriting activities back in 2020 to 2021, right during the pandemic crisis. The difference between traditional credit and private credit is that private credit companies do not have to build up capital that can absorb losses when loans go sour, or even disclose the risk on their books. They're facing far less scrutiny and expense as a result, meaning they can issue loans faster and to a wider range of businesses with potential to reap greater financial rewards than the heavily regulated banks. The size of the private credit industry is still relatively small. According to a 2024 report by the Alternative Credit Council, it is about $3 trillion in assets. That's still a fraction of the global banking industry, which has assets of nearly 190 trillion, according to the Financial Stability Board. But private credit is growing rapidly, and regulated banks have been trying to invest or lend to private credit companies. However, there are differences between the markets during subprime and now. Back then, the weighting of financials in the S&P 500 was 22%. It was the sector with the highest weighting. Technology stocks only took up 16% of the index at that time. Fast forward 18 years, financials is only 13% of the index, while the tech sector is a whopping 32% of the index. And the largest US stocks, essentially the hyperscalers, are cash rich and riding the AI wave. Now, having said that, do watch out for floating rate structures, especially in leveraged loans and direct loans. If demand amongst insurance companies, Japanese banks, and the likes for leveraged loans and CLO retreats, funding cost could rise further for weaker borrowers, even of an absence of a macro shock. Troubles in the weaker borrowers can hurt the US economy, and that can pressurize equities overall. The Fed would most likely be forced to cut rates deeper or faster than they were intending to, in order to stem in the spread of further stress. But here's the catch. Compared to 2007 to 08, trade tensions is the new complication in town. Escalations on the trade front, as the US economy slows, can tie down the hands of the Fed through fears of the resurgence of inflation. So all in all, private credit is a relatively new risk factor for the markets. It is dangerous to brush that aside, as many once did about subprime in the middle of 2007, back when the issue first emerged. However, it would also be far too excessive to be avoiding US equities altogether. So a good strategy to be dealing with this is to focus upon the quality technology stocks that are cash rich, riding on the AI theme, and giving strong guidance in their third quarter earnings. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.